Welcome to the Explainer. This is where we love to dig into the data and pull out the real story. And today we've got a fascinating one. We're looking at a day the stock market basically froze, stood still. And we're going to uncover what that tells us about the major battles that were happening just under the radar.
Okay, so let's get right into it. On the surface, August 14th looked like a total snooze fest. The Nifty 50 index, it moved up by a tiny 0.05%. Barely a blip. But here's the thing. A flat market, one that goes nowhere, that often hides the most intense drama. And believe me, this day was a perfect example. It was a classic stalemate, and we're going to break down exactly why.
So to really wrap our heads around why the market was so stuck, you first have to look at these massive global forces that were in a total tug-of-war. They were pulling the market in completely different directions. It was a textbook case of good news fighting bad news, and it was all happening at once.
All right, so on one side, you had this amazing news coming out of the US. Wall Street was hitting record highs, everyone was excited about a possible interest rate cut, and that kind of news usually sends a wave of cash right into markets like India. But on the other side, you had some serious geopolitical anxiety just slamming on the brakes. You've got this high-stakes US-Russia summit looming, and then there's the threat of new trade tariffs on India. That combo, it just built this massive wall of uncertainty that completely canceled out all that good news.
So, okay, that's the big global picture, right? But what was happening right there, on the ground in India? Well, the story gets even more interesting. It was a straight-up battle of the titans. You had the foreign institutional investors, the FIIs, going head-to-head with their domestic rivals, the DIIs.
Let's start with the foreign players, the FIIs. They took one look at those global risks we just talked about and got spooked. They were heading for the exits, plain and simple. They sold off almost 2,000 crore rupees worth of Indian stocks, just trying to get some risk off the table.
But pushing back against all that selling? You had the domestic institutions, the DIIs, and they were being fueled by a constant stream of money from local investors. So what did they do? They didn't just buy up everything the foreigners were selling. No, they went out and bought almost double that amount. They were clearly looking at this and thinking, hey, this is a huge buying opportunity.
And this chart just lays it out perfectly. Look at that. You have this gigantic wall of selling from the FIIs being met by an even bigger wall of buying from the DIIs. This right here, this was the engine that created that frozen, flat, indecisive market. Neither side could get the upper hand.
The analysts watching this, they weren't fooled. They weren't looking at this and thinking, oh, what a nice, stable, quiet market. No way. They saw it for what it was, calling it a, and I quote, liquidity-driven short-term aberration. Basically, a fancy way of saying it was just a temporary glitch, a pause caused by these two giant waves of money crashing into each other. Everyone was just holding their breath, waiting to see what would happen next.
Okay, so let's shift gears and look at the charts, because this whole tug-of-war left behind some really specific clues in the technical data. And for anyone who trades, this is where the story gets super interesting.
So the first thing you'd see on the daily chart is this formation called a Doji candle. And really, you can just think of it as a picture of a stalemate. It happens when the open and close prices for the day are almost identical. It's the textbook sign of total market indecision. It's like the market itself is just shrugging its shoulders saying, I have no idea which way to go.
Now this is where it gets really cool, because the data itself seems to be confused. First you look at the India VIX, which is basically the market's fear gauge, right? And it's super low. That suggests everyone's pretty complacent. But then you look at the other signals. The put-call ratio, kind of neutral, maybe even a little bearish. And then you have max pain, which can act like a magnet for the market, and it's all the way up at 24,900. So you've got this perfect picture of a really calm surface, but with all this tension pulling in different directions just underneath.
And what did all this do? Well, it trapped the market in this incredibly tight range. You can see it right here. It was holding just above its support level, but every time it tried to go up, it got knocked back down by resistance. At the same time, you've got momentum indicators like the RSI starting to weaken. That's a sign the bulls are running out of gas. The whole market was just coiled up like a spring, just waiting to snap one way or the other.
Okay, so now we have a really good feel for this indecisive, coiled-up market, right?
So let's apply it. Let's see how this all plays out in a real-world scenario. We're going to look at a trade idea for one of India's biggest companies, Reliance Industries, and you'll see exactly why all this background context is so important.
So, a trader looks at this sideways market and thinks, maybe I should put on a short strangle. Now what's that? It's an option strategy, and it's basically a bet that the stock is going to do absolutely nothing. You're betting that it's just going to stay stuck in a tight little box, going nowhere fast.
Now, for a trade like that to actually be a smart move, you really need two things to line up perfectly. First, you need a truly neutral view on the stock. You can't be leaning bullish or bearish. And second, you want high implied volatility. That just means options are expensive, so you get paid a nice premium for taking on the risk.
But here's the kicker. When you actually dig into the data for Reliance at that moment, both of those conditions failed, miserably. Condition 1? Failed. The options data, specifically the put-call ratio, was showing a clear bullish bias, not neutral. And condition 2? That failed too. The implied volatility just wasn't high enough to make the risk worth the reward. So suddenly, this trade isn't just a bet on a stock going nowhere, it's a really dangerous bet that goes completely against what the data is saying.
So what's the bottom line here? It was simply the wrong tool for the job. The entire premise of the trade, the assumptions behind it, just didn't line up with the reality of the data. You'd basically be making a bet against the evidence.
Okay, so if the short strangle was a terrible idea, what was the smart play? What was the data-driven move? How could a trader take all this same information and use it for them instead of fighting against it? Well, the analysis all pointed toward a different strategy, the bull-put spread. Now, like the strangle, this trade also does well if the stock moves sideways. But here are the crucial differences. It's designed with a slight bullish lean and, this is the big one, it comes with defined limited risk.
And this strategy was just better, for a few really important reasons. First, its design perfectly matched that bullish to neutral data we saw in the options market. It was in alignment. And second, and this is probably the most important part, it puts a hard cap on your risk. Unlike that short strangle, with a bull-put spread, you know the absolute maximum you can lose right from the get-go. And when you put them side by side like this, the difference is just, it's night and day. On one hand, you have the short strangle. It's misaligned with the data and has undefined, potentially huge risk. On the other, the bull-put spread, aligned with the data, with a clearly defined risk profile. It's the difference between taking a wild guess and making a calculated, data-backed decision.
So really, the big lesson here is that even in a market that looks totally dead on the surface, the real story, the real action, is always buried in the details. The most important takeaway from all of this is that you have to look past the headline number and make sure your strategy actually lines up with what the underlying data is trying to tell you. You know, the analysis summed it up perfectly. It's about making a shift from strategic misalignment to strategic congruence. And all that really means is you stop fighting the data and you start flowing with it. You put the evidence on your side.
And that really brings us to the final question we want to leave you with. In a market that's just flooded with mixed signals and noisy headlines, is it possible that the biggest risk you face isn't a market crash, but just misreading the story the data is trying to tell you? Something to think about. Thanks so much for joining us for this explainer.